Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a Strategy of the Week update here for May 18th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Been a whipsaw of a day, depending, I guess, where you look, but that could be very true across not only our row crops, but even in the S&P and a little bit in oil there. Markets are on the move. Whether they're trending or not is another story. Maybe some of the macros are caught in much bigger price ranges, but we're certainly moving between those highs and lows with plenty of energy. And then, our row crops, each market seems to be telling a different story. And our one champion for the day, new crop corn, closing positive and bringing a little bit of green to an otherwise very red board today. Let's begin with some of the macros. Let's actually start with crude oil, mainly because there isn't much to say from where we were a week ago. We've been consolidating since mid-May, or into mid-May and through mid-May. The 50% retracement from the highs of April through the lows of May comes in around 73.59, 74 area. Been resistance on the way back up. That was also the old lows for the month of April. Now, old support, now resistance, if you will. The market flipping the book around that figure. 50% swing off of the lows. That's from a 63.64 low there back on the 4th. Through the highs of last week at 74 area, or I guess 73.89, comes around 68.77 untouched. Take a even bigger step back from COVID lows through highs, 50% area around 68. You can make a good case for why there's a supportive cluster of lows, right, between 60 and 70, going all the way back through September of 2021. Once we broke out through the 85 figure, found no support on the way back down, we're now finding it again as resistance, which was very similar to where we found resistance back in the 21 through 2022 period. And I'm fearful that if the market can't get legs above 84 again, we've got a neckline at 60 where crude oil seems to pivot around 60, and there's some macro fundamental reasons why. To not get too far into it, but countries like Venezuela and net exporters like Saudi Arabia and Iran, they build yearly budgets around the price that they can export oil at. By suppressing or keeping prices above or below certain levels, you can actually keep oil in some parts of the world completely off of the market, because it's simply not profitable to take it out of the ground. Somewhere between the $50 to $60 threshold is that area for some newer wells. But then, wells in Russia and the United States and even now in the Middle East that have been established for decades, the cost of producing oil from those is down in the teens and even lower. So, that doesn't take those types of wells out of the equation. And of course, here in the United States, we talk about above 80 and 90 and 100, again, the oil sands and some of the other, newer technologies where it's quite expensive to get oil. But if the economy, and the price of oil, supports that type of production, it comes online. All right, so the big macro, right, is whether or not the U.S. is refilling its stockpiles. You've, of course, got, production cuts out of other parts of the world, and OPEC continually trying to battle the rhetoric, right, that the U.S. might be spewing. But the point is that if there seems to be a bigger fight over the trend, we're right in the middle of the range, and there isn't much to update, so no more than 2 minutes there on crude. To point out the 70 to 74 range in the near term that we need to be aware of. Certainly supportive down, and while we're above 68 in the near term, we slide below there, you take out lows. This can get, and I would think stay below 63 for a while, but I think we're at the low end of the range. I'm looking for this 50% short off the highs to give up their 61.8 level. I'm looking for the market to continue to push up to 76, put pressure on the 80, and otherwise just trade from the low end of this range back to the high end. Nothing super spectacular there. Price action in the last 48 hours has been rather supportive for that to occur. Okay, gold and the treasuries have rolled over a little bit. This can be a, kind of one of those. Well, at this point, I think it'd be weighing in on the rally in the dollar, which if you look at the small screen there on the right, that's the dollar index. We'll get to that right after gold. But you can see that, since the highs of May here for gold, 2085, we have fallen now $100 off that high. We're pulling back into the highs from January, and then the supportive, March lows as we broke through that 1940 area we held as support. We're coming back to test that area now yet again. 1940 is certainly an interesting area. There's trend lines here. There's a 50% retracement from the 1800 swing to 2085 high. Very interesting to see if we find support in this area for gold for then, continuation higher towards 2150 and above. If we don't, we fall back down. We're falling back into this range below this upward sloping trend line support. And 1850, the full 50% swing from 1620 to highs gets interesting, but it's a long ways down. We have to talk about it. But we are coming in on an inflection zone where if gold can't find support, technically speaking, we're just falling back, in the range that we've been in. And when you take a step back on that daily chart here, you can really see how since 2020, 1600 on the low end support, 2000 on the high end, 2100, resistance. That $500 range for gold has been a ping pong game every 8 months or so, almost every year, but every 8 months or so, we seem to be bouncing back and forth. Last 8 month swing took us into the start of this year as Fed policies I thought would start to shift. They are. We are still in a rate rising environment. So I think this pullback in gold is indicative that the Fed hasn't maybe backed themselves too far against the wall, that they might be able to continue to raise rates, because personally, I don't see in the economy or in the stock market where, we have this recession coming, the biggest one that we've ever supposedly had. I just don't buy it. I hope I'm not wrong about that, but again, the system seems to have enough liquidity, and that's the big difference between now and 2008. All right, anyway, gold pulling back, I think, is also in a major response to what we're seeing in the dollar index and what we're seeing in other, like-kinded financial products. Dollar index here, 200-day moving average up around 105 in the June index. I think that's the resistance we're heading back up to. You look at the continuation chart; it's a 50% short, kind of off of this high. It's the old highs that we rolled over from, and it's certainly an old resistance, maybe support. Come back down to support again here. You can see a couple lows into the 200-day moving average. Then we break below the 200-day moving average for the first time. Come back up to kind of test that area again as resistance. Go back down. Come back up. Just price discovery, right? And we know that when we look at the dollar index as one of the bigger macro commodity confirmation markets, I guess. We know that we've seen these 10-year, almost decade-long ranges that have existed, here between 90 and 100, here between 70 and 90. This is the post-recessionary lows for the dollar. Then this is the recovery, and then what I would call the Fed's taper tantrum, if anyone remembers that era for the Fed from 2012 through 15, where we had a little mini rate rise and some, basically the Fed went from negative interest rates to ending quantitative easing to reversing this, that whole paradigm, but generally kept accommodative policies here through 2020 would then, interestingly enough, we saw the dollar rally alongside inflationary pressures. And I think the dollar rallying was really the accumulation of dollars by China, by net commodity importers to come around and turn around and spend on U.S. commodities, which then, or anything U.S. dollar denominated, right? Then you go on a spending spree with all the accumulation of the currency you've gotten. So we've come right back down to that breakout area around 100. We fall back into this old range. I mean, it's just a very technical, almost $10 or $20 ranges in the dollar index. That if we fall back down, we're going back down to 90, in my opinion. Going back to the lows from 18 through 20. That's what I would like to see for gold to break out through to new highs, for the treasury markets to do their thing, get back to the 140 handles. And along that same period, you might see other commodity markets really get going. But again, dollar index here well off the highs. Bounce here, not out of the question. Reversion to the mean. We're still, only just now coming up to test above the 100-day and 200-day or 55-day moving average. But again, it's this 200-day moving average up at 105, where I think we're probably heading up into. Big three waves up. We'll see what happens with this dollar index. Okay, so I guess since our shining star today was December corn, we can begin there. And when you look at a chart of it on the daily context, it's definitely not a shining star. It's a falling knife. But, from, April of 2020 through the highs of this last cycle, I mean, we rallied from 350 crop to a almost $7 crop. We have to take a step back and realize the price of grain from the abysmal lows of the recession, which was a recession during man-made or otherwise during COVID, to, peak inflationary pressures when Russia's invading Ukraine. We almost doubled the price of grain during that period, and this December chart shows that. We have only walked back 50%. We're down from a $6.50 high down to $5. Don't get me wrong, no one likes seeing that from the production side or, for a farmer, because that's a lot of lost revenue. But I would also remind everybody that when you take a look at, continuation charts in corn, and you take that big step back, we are doing very, very good relative to 5-year averages. We're doing very good relative to a 10-year average for corn. The 10-year average for December corn, and you just look at this chart, it's the middle of this range, right around 520. We just pulled back to the average price that corn has been at, between basically not really falling below $3, but not really ever breaking out above $8 in the December contract. We're just, right? Big picture. Can it hold here and go higher? Sure can. It did last year, right? It did exactly that from the last year's time frame, and in December corn, not in the December 23 contract. This was December 22 corn did that last year. All right. Anyway, equal legs down, right? So if you measure from the highest high there in corn down to this swing low in July, take that range and drop it down off of this October high. That had equal legs down around 498. So we've traded 3 big waves down in equal legs. For any Elliott waver or fractal trader, good thing to see on the daily chart, but it doesn't really help you make money. Being up $0.0125 though today, with a nice long tail, it at least gives us a setup where, coming out of oversold conditions on the RSI, 10-day and 18-day moving averages above us, with of course the rest of them well above. And arguably a trend line against the very short-term trend here, which probably comes in right around that 10-day moving average anyway. A key reversal after a day like today, plus breaking above some of these other short-term indicators. There's a long way up for December corn. In fact, we really, really have not given the 540 to 550 area, which was very big support. I mean, huge support from last summer, huge support here into the spring that we finally broke. Yes, but we need to test that area as resistance, just in my opinion, from a price discovery standpoint. So who knows where the bottom right is, and when the knife stops going down, when the pressure and the funds start lifting their trades, and the short covering rally begins. But once it begins, I think there's plenty of room to the upside here. 50 cents at least back to the first major resistance area, and 90 cents to the 200-day moving average, which that doesn't even put you above $6. we could still roll over from there. But I don't know. I think we're been saying this for the past couple of weeks. We've been, how far down and how much premium do we need to take out of these markets before we start saying we need to build some back in? Got to wonder if we're not getting there. Certainly when you look at those continuation patterns over the last several, crop years and where maybe we were in terms of carryouts, no doubt that we can have a great production year and get ourselves away from out of the, off the burner here for tight stock to usage ratios, but we're not there yet. And for many people right now, that national 181 yield, is just a bag of seed. Not a ton of people, but there are still people out there, right? And of course, that's changing. And once all that seed's in the ground, in just a few weeks, we're into complete weather markets. And if the great weather conditions that have been forecasted for this year, because really, I look at all the weather maps, and we were looking at this with our team here today, we see a lot of problem areas getting better in terms of what the mapping and the things say, right? They're forecasting for a lot of improvement. If that improvement doesn't come, right, we're seeing as bearish as it gets. And I'm not saying that that's what you can go out there and bet on, but you can definitely see how we are hunting and trying to find a low in price with that idea. And everything will probably turn around an interesting time and happen together if it's going to. But we're at the point now where there's a lot of money leaning onto these charts, so we'll see. On the way back up, let's take a look at the July corn here, because that's where we'll take a look at the short-term technicals. And, December corn was positive today. That's great. July corn was still lower. Will we see bull spreading, in an environment where, where December is just relatively better bid? Maybe. But anyway, December corn making a new low below the 580 area. It's kind of a similar level to that 540 in December corn, which is, of course, why it's been busted down a little further, or why we're looking at it that way. But certainly in the last 24 hours, we've been trying to play some catch up. So we had some old trend line support or some kind of trend channel. We've now gone parabolic. We've broke below that trend channel. This is usually the time where shorts need to either absolutely continue to crush it and you start to see like limit down type moves, or you don't. You start to see the covering because things have just gotten too extreme. We were coming off of oversold conditions. We're going to go back into them here if we hang out down here for much longer. We've already broke below that trend line support around the $6 area, kind of held it as resistance, but 18-day moving average and the 10-day are still up around 584, 55-day at 610. 200-day all the way up there at 640. Let's take a look at the smaller time frame charts. It's a very similar three-wave structure down in equal legs here in July corn, just like that, just like we looked at there for the December contract. But July 4-hour chart here did not quite make it up into the next in the series, 50% short. If we were stair-stepping lower, 2 steps down, 1 step up, 2 steps down, you'd expect that 1 step up to take you into 608, 610. Doesn't have to, right? The market found a range down here between $5.80 and $6. Felt very comfortable, 570, trading that range, consolidating, and it happened to also, be below. Take a step back here, below this old low, right? So we broke below lows, consolidated there, price discovery, felt comfortable, then it started to break and continue lower. Now we're going to be looking for similar type price action, right? That range or wherever support decides to put its footing in, maybe a quick recovery that takes you back above 6, and we could call this some kind of V shape. But for the time being, certainly from highs to lows for the month of May now becomes a 50% short. We're going to be, or a 50% level we're going to be watching and eyeing. And these aren't necessarily to take. Sometimes they're just, hey, shorts have now given up a level we would have expected to see them at. That's the reason that we'll start to recover. Full 50% shorts from the 705 highs, swing high to lows are 625. At some point here, we're going to be looking for that bigger short covering rally, but things just keep stair-stepping lower in the near term. And resistance just seems to keep building, right? Like we go through old support, now back up into 570 is old support of this range, as well as a 50% off the highs. So it's like you can find those reasons to be a little more bearish sometimes. That's not always great. All right, let's move on because there isn't much to say about corn. I guess the exports today, right, were pretty abysmal. I will say this: corn and wheat also have been hit with that news of the 60-day extension of the Black Sea grain deal. That, of course, weighed down the markets the last couple of days. Exports today were abysmal, though. Some of the trade were expecting some cancellations, and the actual coming in with cancellations of old crop corn. New crop was also on the low end of expectations there for exports, and so it's just no new good news, right? We've just seen no good news. Soybeans were actually on the low end there for that new old crop export number, kind of bad as well, but crushed it, almost doubled the expectation for new crop beans. Just kind of weird, right? What is China doing buying new crop beans if Brazilian and the rest of the world are so at such a discount? I don't know. I'm starting to wonder if soybeans aren't getting undervalued here. And we've technically speaking gone through the supportive trend line on the chart. Okay, going back up to test that before heading lower is not out of the question. 18-day moving average is way above us now at 1403. I mean, that's 70 cents above us, right? Like, we are way oversold at this point. Really just have the summertime lows around $13 as a kind of the next support on this chart. We can get rid of this old trend line because who cares about it now? We're just in the range until we're not. Wondering in my heart of hearts if I want to see it flush out and capitulate below 13 and then V-shape up, or if it's going to bottom here and then we have this kind of sideways price action before inevitably at some point it either breaks above 15 and 1550 or breaks below 13. But that's not the problem of July. The July contract. It's going to do what it wants. All of our moving averages are way above us, so it just feels very oversold at this time. We'll take a look at November real quick. Broke below its kind of the summertime low and trend line, so a move back up above $12 to $12.50 to test old support as resistance, not out of the question. But this is three waves down in a bit of not quite equal legs, a little deeper, but three waves down. So July corn, December corn, November beans all have made three waves back after a considerable run up. So I mean, that is just from a when you take a step back in the daily chart, this looks like a big impulsive move and a big correction. If you're an Elliott waiver or you look at any kind of chart, I mean, these are all just big daily bull flags. They're just happening at really, 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 really big levels, I think. So, and pennants. So I still got to kind of keep that consensus going for corn and beans, even though, man, we joke about it, Joe and I here in the office, that it's too late to sell but too early to buy, and I think there's some truth to that. But I don't think it'll be too early to buy forever, right? All right, let's take a look at soybeans now here in the July and the 4-hour chart, because there is some pretty technical price action here going on. If you just consider the swing from 1501s as we started lower, you had 50% shorts here off of the highs at 1445. Right, three waves up into that. So like flip the daily chart of soybeans upside down. It looks a lot like this drop and then three waves up. The daily chart of soybeans looks like a big rally and then a drop of three waves. It just looks like that upside down is my point. Anyway, went down to targets, went to secondary targets down here at 1323 without pulling into the next in the series, which would be drawn from 1446. Highs to lows, the entry highs to swing lows. So 1380 is still kind of resistance there in a 50% swing if it wants to do it. But now we draw from a low to low here. So from this 1390 area, 1400 down to lows, you can see those two fib poles that have resistance around 1360 and 1354. Interestingly enough, 1354 gap fill, right, from prior in the chart that can actually take off because that's been filled. But resistance at 1360, at 1380, above 1400 again, we get really bullish, and we can talk more about the long-term swings higher. But if we start to get above 1360 and start to see reasons for support, there could be reversal setups to be talking about, but you got to wait for them to happen, because everything on this chart looks like downward sloping trend lines, looks like lower lows and lower highs, looks like extension shorts, looks like 50% shorts holding. It's very technically being sold into. And regardless of what we think about carryouts and fundamentals, Supply and demand economics are repricing in the biggest bout of inflation we've ever had, at least in my lifetime. So, the last time inflation was this big was my parents were in high school. Um, so, we got to remember that maybe that daily chart or that weekly chart is more important at these levels than any of these short-term, 10 and 20 and 40 cent moves we're seeing, which are impressive. But when you consider the adjustment, right, and the new normal we're finding, I think it's keeping prices at considerably higher averages from the 5 and the 10-year, retrospective. Granted, input costs and everything are up, right? But that's inflation. So we can't afford for these prices to drop because the input costs are not dropping darn near enough. Anyway, so definitely resistance on the short-term bean chart to think about and look into. Back above 1360, there's a lot of pricing ideas to talk about, but nothing to really do in the short term. Chicago wheat 611 and 3/4, abysmal close down 13 and 3/4 cents, but was not as nasty as our spring and winter wheat varieties there, which have a lot more exposure to that Black Sea deal, given it's it is the global wheat, but however, Chicago wheat has just gotten so leaned into, I think, over the last several weeks that you're starting the effects of today, at least what I see with Chicago wheat down 13 and down 30, 3 times that, right, in KC and Chicago and spring, which have been wildly stronger, right? Their spreads are at $2 premiums, well over $2.40 premium, $2.45 there over the Chicago. I think this is the market unwilling to find a seller. Why is it Chicago below $6 right now? Why weren't we down 40 cents in Chicago if it's so bearish and so crappy? Why were they not leaning into that one and running it? I think it's because the sellers have run out of ammunition, right? At some point, sellers get exhausted, and I think this is what it's starting to look like on the Chicago chart. I'm not calling a low yet, but boy, if Chicago were to hold above 6, KC and Minneapolis start to spring back towards their highs of the month. This all looks like, a market running out of sellers that's very short. Once the short covering begins, it can flip the other way very quickly. But it's still, right, wheat is still at the low end of the recent range. And certainly in the last couple days has not given me any reason, to want to come in and be a buyer. All right. 200-day moving average up around 780 there in Chicago wheat. The 18-day moving average, which, and the 10-day around 640. I'm just going to go with the 670 highs of this recent range that we've seen. Below 6, there's nothing stopping it, from going lower. Above 670, though, I do think we would start to see some serious short covering. You'd flip many different technicals, and at that point, you really don't have anything but air above until like other resistance zones that the market should naturally, right, through periods of price discovery, go and find. All right, so KC wheat and spring wheat, not so much different, but the KC wheat, I'm interested. 830, what are we going to do on a pullback there? That's what that 18-day moving average is. Today was a break above the 200-day, a pullback to test the 10-day and the 200-day, maybe a support. These old kind of highs around 880, something like that. We kind of get rejected. But KC wheat, and we'll look at this on the 4-hour chart here in a minute, did break the 50% of its, kind of last swing from highs to lows. So expecting it maybe to pull into 50% from lows to highs in what we refer to as an ambush setup, and then try to establish itself above all these major moving averages in the same process. Wow, that sounds pretty good if it starts to happen for, bullish development. But hey, a sell-off from 920 down to 845 here in 24 hours or 48 hours, just over, definitely makes you hold your breath a little bit, right, as a long, or if you're going to step in here, maybe take a second and reconsider. Here's that 50% from the 1007 area down to the 736 low. We went above that with the 911 break above the high. We were trying to break above trend lines here. We kind of failed back. But breaking that 618 line up around $9, this ambush long from 735 lows to highs, 827, Wouldn't necessarily put an order out there just to be a buyer because wheat's pretty volatile right now, but get down there, we show support, it starts to show reversal setups. That's where I get inclined to start taking, stabs in the smaller time frame. Can you intraday get long to a position that's, hey, positioning on a swing here that might take you all the way up to new highs for the month, right? That's the dream, and what the goal is for that plan. It's just, of course, any of these plans, it requires the market. We're tracking footsteps of the market and and participation and behavior of other more influential players that move price action that we can only hang on to the coattails of, and try to identify when they're taking 2 steps forward, 1 step back, hop in on that trend, and try to take those 2 steps forward with them on the next go. Wheat has been in such an interesting chart the last few months that I think it's finally getting to the point where we've built in too much bearish attitude. And even with wheat cancellations, which were minimal here in old crop, new crop exports were pretty good. But where's that wheat going to come from? New crop exports for wheat were on the high end of expectations. I'm sorry, is Kansas still not in a record drought? You've seen the bad reports, right? So I don't know where those exports are going to go. I think we need to price ration further if exports are going to keep going that way. And you're going to look to the spring and the KC wheat for that export market to really drive price up. That's why there's a $2.45 premium there, because that's the wheat that they care about. If they cared about, Chicago wheat obviously has to drop now because of its lower protein content to even remotely compete with those wheats. And by the way, the price now of Black Sea wheat, which can have wide variability in that, and not only that protein amount, but that quality of the wheat as well. So, just moral of the story is for wheat, Chicago could be doing a double bottom while KC and spring wheat are doing a bit of a pullback into 50% areas that we should pay attention to, because they could offer maybe some support and an interesting setup if it chooses to make it. All right, let's round out the day today. I guess before we go to cattle, let me give some eyes here on cotton, because cotton this week did finally break in the, let's look at July cotton here, leading the way here, a $3 premium to our December contract. But July cotton breaking above that 200-day moving average, above that downward sloping trend line. Last time it tried to do this, it kind of faded back down into the range, and we made a bigger range for further and longer. But we're at a time of the year where these ranges don't last. We need to break down and either discount the acreage in the cotton that we're putting in because production's so good, or we need to break out and up and start to, well, it's too late to buy cotton acres, but we certainly need to start price rationing demand if we see any struggling there. So anyway, weather markets are in full swing. Technically speaking, on a chart, we are starting to go above that 200-day moving average at 85. I've gotten protective at 85, right, for people who are doing reownership and being on the long side. I think that's a good place to not let the market go back down into, because if we do get below 85, we're going back down to our old range. We could easily go down to 80. So what I'm saying to you is that, hey, now that we've broken above that strike, the $85 puts make sense as a protective strike, right, to own if you're trying to negate long side risk. In other words, if you're either long in the bales or the bins are on the board, that's what I'm talking about, using a put protection as we've come up. The puts have kind of gotten cheapened. You can get a nice high and tight one, and if the market runs away from here, that the insurance cost, you chalk it up to for the put, did its job. If we break back down, boy, you just pray and thank the powers that be that you have it, right? December cotton, similar looking chart here, but hasn't made as much progress, has not broken above the range high that we've been in since April, but is breaking above its trend line highs. Already above the 200-day and all of its cluster moving averages, mainly because December cotton's been a little more sideways and a little less volatile, but nevertheless, I think a push above 85, 86 here. 90 to 95 needs to get tested and to reopen the book up to the larger high end of the range. And if that's the case, watch for July cotton to continue its rally here. July cotton, not much in the way back above the 200-day moving average until it gets back up to 100 here. So not saying it goes straight there in a line, but our softs are sometimes have that highest confluence to rally or to trend. Feeders and fat cattle here today. What a wallop of a trend we've seen. Feeders being the leaders, up 3.25 points there in the September contract, making new highs. Just absolutely parabolic. I mean, if you're selling this, hopefully it's as a true hedge. Hopefully, you've that's all I can say about it, because it's definitely a trending market. We're not quite to overbought conditions yet, so this new push into new contract highs, I think, has legs to it still, unfortunately. There's going to be a little bit of up and down up here, but you can see here on the daily RSI, technically got room to go. Even if you draw trend lines against the highs, got room to go. I think this 240 area is probably in the works. That's all just projections. Nobody really knows where it's going to stop. It's no different than a falling knife here. Kind of got to wait for the market to tell you and turn back over. Support's clearly going to be down in this 225 to 220 area. If it really breaks down, 18-day moving average, get the 10-day crossing back above it here today at that 231 area, 55-day at 225, and 218 for the 100-day moving average. The fats in the June coming up on their contract highs, but still below that 166 figure. I would be shocked if this did not break out towards 168, just given what the feeders are doing. But we are starting to go into overbought territory here on the daily RSI. So maybe a little hesitancy out of the fats. I do think we're starting to go up into prices where you would imagine consumer rationing a little bit, their purchasing of beef. Certainly if we're going into the recession everyone's talking about. But hey, if you're looking at the price, if you're looking at charts of cattle, you're looking at charts of the S&P, I just don't see where you see where people see the world's the biggest recession in history coming, and I will keep harping that tune until I'm wrong, which again I hope I'm not, because no one likes a good recession. But again, breaking out above contract highs here for live cattle kind of seems like I'm surprised, right? It hasn't already done it. Got open gaps down below us that at some point, maybe we'll fill, but we really can't. You can't go betting on those here in the near term. The 4-hour chart here for June cattle, or the hourly 4-hour chart, whichever one we want to look at here in the near term. Again, we've really pushed up against resistance. If we pull back, this open gap in the 160 area is a 50% retracement. We could pull back to this 156, 157 area where there is just a tiny little itsy bitty open gap from back in March. But while we keep those open and we keep putting pressure on highs, right, upward swings towards 169 to 170 should be expected. So, okie dokie. Let's see if there's anything else that caught my attention today that is worth noting or talking about. I guess just we can close the day out here with a little bit of the S&P 500 breaking out, I think now finally above the 4,200 area. We've been identifying this downward sloping trend line and or a couple of them, but kind of tracking, I think, the progress this chart is making and trying to break out of resistance over the last couple months. And so be it. Here we go. We're going up 4,200, 4,300, 4,400. We'll take out the swing shorts. At that point, there's probably a high probability of a pullback towards 4,000, but this is all daily and macro stuff. I think the big swing and the big pullback already happened to 3,500. I think the swing up towards 5,400 is underway. We're not going there in a straight line, as you can clearly see, but I think a lot of up and down here between there and then is definitely probable. In the very short term, though, going down to a 15-minute chart here today, we've had pretty much just consolidation sideways in a range between 40.60 and 4,200. That tightened up here into the end of this week between 41.60 and 41.20. And this is just a market breaking out of sideways price action. So you built up energy. Now it's expending that energy. When you take a look at the hourly, the 4-hour, and the daily chart, there are lots of resistances that we have been bottling up against that this market is finally popping through. So, would not be at all surprised to see it sell off down to 4,100 still, as this, the market's been generally in this kind of expanding bull flag. but today might be the day we actually are breaking out of it. So, all right, well, with all that being said, thanks for joining me here for our Strategy of the Week webinar. Again, I'm Dan Hussey with Zaner Ag Hedge. You can always get in touch with me over here at 312-277-0110. Find me at Daniel Hussey Jr. on Twitter, Dan SOTD on Facebook, or shoot me an email at dhussey@zaner.com. You can sign up for this webinar to be a part of it every week here at 1:30 p.m. Central. There's a Zoom link and then a recording that goes out after it. You can find the links to that in the information and comment section of this video. And also sign up for our daily Zaner newsletter, where you can hear from myself and our entire team's daily commentary about not just the agriculture markets, but the entire futures and commodity market spectrum. Have a great day, everybody. Have a great weekend in case we don't touch base here tomorrow. But the way markets are moving, probably we'll have something to say, especially considering our row crops might, have a chance for reversals if certain things, play into it, right? We're not there yet, but we're certainly at the point where you can start looking, not trading for, but looking for the signs to put a plan together to take advantage of it when it happens. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.